Hello and welcome to the look ahead for the week starting July the 21st with me, Fiona Cincotta, Senior Market Analyst at City Index. So just before we get going, as always, I'm just going to ask you to have a quick read through the risk warning whilst I put myself on mute. Let's kick off. So just going to actually start by having a quick look at what's going on, where we are in the markets as we head into the weekend. We've got US S&P 500 and the Nasdaq trading at record highs. Now, these record highs have come across a week where we've seen solid earnings from the US banks, from PepsiCo, from TSMC, which is the largest chip manufacturer, again indicating strong demand for AI chips, which has helped the tech sector push higher, helped the Nasdaq, helped that tech sector in the S&P 500. And at the same time, we've also seen the US dollar struggle a bit. So it did actually rise to its highest level since the 23rd of June, but it has since just eased very, very slightly, and we're just hovering around that 98.25 level. Now, there have been a couple of, as I said, we've had strong earnings. We've also had solid data. So US retail sales came in stronger than expected. Initial jobless claims were lower than expected, which has also sort of helped this mood. And tariffs, you know, we're still not having the trade deals that the market wants to see with the likes of the European Union, for example. But we are seeing that the market is shrugging off these concerns with trade tariffs as we move towards that August 1st deadline. There have been some suggestions that deadline could actually be relatively fluid. So, I mean, the market doesn't seem too stuck on those concerns, but what we have heard is a lot of Fed bashing. So Federal Reserve Trump, there were some rumors earlier in the week that Trump could fire Powell. That sent the US dollar lower. It also caused US stocks to wobble, but then that was quickly denied. Now, that would interfere with the Fed's independence and ultimately its credibility if something like that did happen. I mean, we don't even know if it's legal, so it could then result in a whole world of legal showdown afterwards. But it's just that thing to keep in mind, because we don't even need Trump to fire Powell for the market to start guessing at what's going to happen with rates. We only need Trump to nominate his replacement, which he could do earlier than the May deadline when Powell will be leaving. So that's something to keep in mind, something to bear in mind as we head into next week. Now, next week, again, as we head into next week, themes are going to remain relatively similar to this week. Liquidity, obviously, we're in the middle of the summer doldrums, so volumes tend to be lighter. Also trade, any trade developments will also be digested by the market. But as far as the economic calendar is concerned, we're actually quite light on data. I mean, we've got the sort of from Australia, we've got going on early. I mean, we've got the Japanese elections over the weekend as well, actually. But then, I mean, it's not until Thursday really when we get the PMI data, ECB rate decision, and Japanese Tokyo inflation that things really kick off. But again, you know, a light economic calendar, but what we do have is earnings. So earnings will be ramping up. Now we have earnings from Tesla. We also have earnings from Alphabet, as well as 2 UK banks, Lloyds and NatWest. So, I mean, let's just start. We'll start off with what to be expecting from the from earnings. This is Tesla. It's currently trading sat on. There we go. That's the weekly chart. I mean, we're well down from those highs that we saw just at the end of 2024, but let's just pull back up that daily chart here. You know, so as far as what to expect from Tesla, Tesla's going to report earnings on the 24th, I do believe, 24th of July. 23rd of July after the market close, and basically the numbers come as the share price trades around 15% lower year to date, so underperforming the broader market. We are trading on top of that 200 SMA expectations. So sales and revenues, margins are all expected to decline as the EV makers navigate the fallout from CEO Elon Musk's involvement in US politics and, of course, rising competition. So we already know that Tesla missed deliveries with a disappointing 384,122 vehicles delivered. That was down 13.5% year on year. So basically, we're seeing here a fading EV market share, rising competition, and a brand that has been tarnished by Musk's foray into politics. Now, furthermore, we've got Trump's big, beautiful bill, which was signed into law this quarter, means a loss for EV tax credit. And that's already resulted in a temporary price cut on Model 3 and Model Y vehicles. One of the other key points this earnings season will be Musk's position on robo-taxis. So we had the Tesla launch of the robo-taxi in Austin, in the US on June 22nd with just a small number of Model Y vehicles. Now, this is a small scale. There have been some reports of traffic law violations which are being looked into. So, you know, a few teething problems to say the least, but I do think that if self-driving technology starts to ramp up over the coming years, then that obviously can be a game changer for this stock. Now, expectations are for EPS of 43 cents, that's down from 52 cents in the same quarter a year earlier. Gross margins are expected to stabilize at 16.44%, down from 16.3% in Q1. And revenue is expected to fall 11% to 22.8 billion. Just have a look here. We're just trading below this falling trend line, recovered from the lows that we saw down here in April of 215, and we're just sitting here very neutral. We've got the RSI at 50. We're on top of the 200 SMA, waiting for a breakout. For the breakout, 335 on the upside, and then 356 for confirmation. On the downside, we'll be looking for a breakout around the 300 level with potential confirmation at 288 to create a lower low towards this 215 level. So let's just have a look also what all this means for the NASDAQ. This is the NASDAQ. Again, as I said, trading at record highs thanks to upbeat earnings from TSMC. Yesterday, driving that demand for AI chips and AI generally. So this is the NASDAQ. So also next week, let's talk about Alphabet, parent company to Google, due to report on Thursday the 24th after the market closed. Basically going to be watching here to see how the company navigates increased competition from AI and search. So basically with the rise of ChatGPT and AI reliance, the traditional search engines and advertising revenues could be seeing growth slow. Now, obviously, Alphabet has launched its Gemini 2.5 Pro, so that's its latest generative AI model in order to leverage its vast user base to drive AI adoption. Now, the AI overview has been integrated into Google search, so we are seeing some signs of it sort of enhancing existing products with AI. Now, Google Cloud, also biggest growth opportunity and driver, and the division is expected to grow revenues by 26% in Q2 as the sector makes gains from and picks up market share from competition such as Amazon and Microsoft. Expectations here are for revenue to be 93.8 billion, that's up 10.7% year on year as growth moderates. If we get encouraging earnings, could continue to see the Nasdaq power higher to fresh record highs. We are just teetering into overbought territory, so it is worth keeping an eye on. On the upside there, 23,500 next logical level with blue skies above. As far as support's concerned, I'd say sort of the 22, just around the 22,600. That's the rising trend line that we have dating back to late May and also the sort of 22,500, just the low that we've seen in July, or recent weeks, I should say, not quite in July. If we get a break below, really to negate that near-term uptrend, we need a break below 22,000. To get a break below 21,500 to create a lower low and change the structure of the chart. So, and then let's just talk about UK stocks as well. We do have UK banks, which are reporting. Now, next week we have Lloyds and we also have NatWest. Lloyds have actually, well, the banks more generally have performed well across the year. Lloyds is up around 40% year to date, outpacing the other major banks. Broadly speaking, the analysts across have been bullish on the banking sector for some time, and that's basically because of resilient earnings and also robust capital returns and easing regulatory requirements from the Bank of England. That's really improved the sector's outlook. We're expecting another solid quarter for UK banks, basically underpinned by stable net interest margins and strong underlying capital generation. So this is the FTSE again, you know, trading near record highs. This week it hit a record high of 9,043. So it's trading above this level. We're just seeing some consolidation really just around that 9,000 level. After the price recovered above the 88.70 level, and just consolidating, as I said, just below the 9,000. Buyers are going to look for a close above 9,000 to bring 9,100 as the next logical upside. This level here is quite important on the way down, the 88.90. That's because it was the high that we saw back in February. It's also the rising trend line support. A break below 87.60 needed to create a lower low. So moving away from earnings now and just moving towards the ECB and what we're expecting there. Okay, so this is the euro-US dollar. So ECB rate decision due to be on Thursday. Widely expected to leave interest rates unchanged at 2%, which is signaled to in the June meeting, particularly as Trump's threat of 30% tariffs on EU imports could really complicate decision making. But there's still obviously time for the EU to strike a deal with the US, but we still don't know whether that would come in or not. And as a result, the ECB is being forced to come up with new estimates because 30% tariff is a significant, well, it is higher than what the worst case scenario was previously. So policymakers will be really reluctant to act on what's considered a threat right now until there's sort of something a little bit firmer from Trump, and particularly given his contradictory statements. I think any discussions about rate cuts is likely to be postponed to September meeting, when the ECB is hoping you will have a better idea of what is going on as far as trade tariffs are concerned. Should policymakers sound cautious and concerned about the uncertainty of the outlook and potential impact on growth in the EU, then we could see the euro come under further pressure. Now, this is, as I said, euro US dollar. We had that rally up to a 4-year high of 118.30, has since moved away, but found support here at this 115.80 level. And we're just recovering a little bit higher. RSI is pretty neutral. So if we do get a sort of a cautious sounding ECB, then we could see this level come under pressure. If we get a break below there, that will open the door towards the 115 level on the downside and 114.50. On the upside, buyers are going to need to look to rise above the 117 level in order to extend gains towards 118. And also, let's just have a look at the DAX whilst we're here. Now, the DAX isn't quite trading at record highs, did reach a record high last week, is back this week, seeing that recovery again. Buyers are going to need a break above the 24,650 in order to extend this bullish run that we're seeing up towards the 25,000 level. As far as support is concerned, we've just got the 24,000 is a level to watch out for, round number, as well as the 20 SMA. I'm not going to get a lower low unless we come down here to the 23,000 level. Okay, and then let's just take a look at USD Japanese yen, because now we've got elections in the Senate in Japan on Sunday. The upper house, sorry, elections in Japan are in focus. I mean, they've also just been weighing on Japanese government bonds as well as the yen. Now, I mean, there are concerns around political uncertainty and looser fiscal policy, and also the effects of, you know, the Bank of Japan policy normalization. All of this has contributed to bond weakness. Now, the ruling coalition needs a minimum of 50 seats out of 125 contested to secure a majority in the upper house. However, recent polls have suggested that there is a significant possibility that the Liberal Democrat Party could fall short of expectations, and basically that could result in potentially a snap election or a new coalition, or the outcome could be complicated for government policy, particularly given that we're at this time where there's also the US trade negotiations going on as well. So a lot to there's a lot to be keeping in mind there. And then in addition to that, we've also got the Tokyo CPI. Now, Tokyo CPI, this is going to be on Friday, and is expected to edge down slightly to 3% year on year, whilst core CPI is forecast to remain unchanged at 3.1%. Now, basically what we've seen here is food prices are expected to ease during the month, while services and manufacturing food costs are likely to have risen. Now, the reading is going to be closely watched by Bank of Japan policymakers, as recent inflation has been a bit stronger than the central bank's expectations. Now, the Bank of Japan is likely to upwardly revise its inflation outlook for fiscal year 2025, and as a result, it's possible that the Bank of Japan could hike interest rates sooner. So if this was the case, we do get hotter than expected inflation, then that could basically increase Bank of Japan rate hike expectations, which would be beneficial for the yen. Now, this is the USD Japanese yen. Now, we've seen a recovery in the pair to this 145.65 level, which was the high that we saw in May. And, you know, we really need to have a solid close above here to bring the 200 SMA at 149.58 into focus, and the 150 round number. Now, obviously, this is proving to be a little bit of a barrier at the moment. The near-term uptrend, a very near-term uptrend, is very much intact. But yeah, we do need to move above that and a close above that in order to extend gains. Now, if we do get the uncertainty from the elections over the weekend, that could be sufficient to push this higher. Obviously, there's also the US dollar element in here as well. Now, we've had plenty of Fed bashing, as I mentioned, from Trump, which could keep the lid on any US dollar gains. We did have strong data this week for the US, which has highlighted, highlighted that the US economy is proving to be resilient despite all these uncertainties surrounding tariffs and erratic policies from Trump. So, but whilst we've got Trump Fed bashing, it could be difficult for the US dollar to really, or we could find the upside limited in the US dollar. So if that is the case, then the USD Japanese yen may struggle to push above this level. Now, if we do get above 150, next line to be looking for is 151.35. That was the high that we saw at the end of March. On the downside, if we fail to move above that in a meaningful way, look down for the 146 level, which was an important level on several occasions. And then below there, we sort of come back to the 145 level before heading towards 142 on the downside. So we've done UK earnings with the banks, but we do also have UK PMIs, just to bring up pound US dollar, because this is falling out of below that rising trend line that we've been trading above since the start of the year. Now, as far as data is concerned, we've got in June, the PMI data expanded modestly as new orders grew for the first time this year, but employers cut jobs more quickly, which just also added to these concerns about the jobs market. Now, investors are going to be looking to see whether these trends continue in July. Data this week showed UK jobs market weakened further and unemployment unexpectedly rose to 4.7%, whilst inflation also was higher than expected at 3.6%. So this really highlights the Bank of England's challenge as it looks to reduce interest rates. Now, with this in mind, we're going to be watching whether prices paid and the jobs subcomponents of the report, particularly the service sector, which is the dominant sector in the UK, really continue to support this sort of inflationary outlook. And the outlook also for the jobs market will be in focus. Stronger than expected inflation, stronger than expected data could give the pound a boost. Obviously, weak data is going to raise concerns over the state of the UK economy, where we just seem to be having sort of growing headwinds as far as jobs are concerned, as far as inflation is concerned, as far as the economic growth outlook is concerned. So lots to be weighing up. Just as far as levels to be watching, on the downside, if we do get a break below the 133.75, this is the level which has held up. It was also tested back in June before we recovered higher to the 3.5-year high just below the 138 level. We found support there at that 133.75, 133.65 level, just attempting to recover above the 134. You know, if we can get above here, which is the 135, which is the 50 SMA, that will then bring obviously 136 into focus on the upside, 20 SMA, also round number, and highs that we saw in early June and late May. To create a higher high, we need to get above that 138 level, which I think is looking quite toppy, given the outlook for the UK economy. On the downside, as I said, broke below 133.75 brings 132.50 into focus. So that is all we have time for, folks. I hope you have enjoyed it, and I look forward to seeing you again next week.